entrepreneurs is not specifically on our agenda, it's worth spending some time considering the extent to which the Venture Finance Institute should be involved in educating nonprofit entrepreneurs. One of my jobs this morning is to make sure we all communicate clearly with each other. Because some participants at the conference have limited familiarity with venture capital, it's appropriate to spend a few minutes describing how venture financing works and how venture capital funds are organized in the U.S. Venture financing is financing that's suitable for high-risk ventures that have the potential for profitable and rapid growth. Because the concept of profit technically does not apply to nonprofit enterprises, we can think in terms of high margin or high free cash flow. In general terms, new ventures go through stages, ranging from pre-revenue or development stages through the startup of revenue-generating activities and through a series of growth stages that differ in terms of their cash needs. Normally, in the case of for-profit ventures, exit or harvesting of early-stage investments occurs at a point when the market or a prospective acquirer can relatively easily recognize the value of the venture. This pattern is similar for nonprofit ventures. The main difference relates to how early-stage investors realize their returns. In the for-profit sector, the return is realized by selling the equity to a later-stage investor or in an initial public offering. In the nonprofit sector, the return must be realized in some other way, such as through debt service payments or through a royalty or similar revenue stream. The stages of new venture development relate to financing stages. For very early stage ventures, financing is not based on what the investor can discern about the prospects of the venture. Rather, it's based on collateral, the entrepreneur's reputation, and the ability of the entrepreneur's other assets to generate cash. Financing at that point is essentially bootstrapped. Seed financing refers to relatively small amounts of capital that are intended to advance the venture to the next milestone, such as capital that's used to finance the completion of a business plan. Beyond that, as the venture develops positive free cash flow, the financing rounds tend to become larger and less risky. For high-risk early-stage ventures, financing sources include internal or strategic partner financing by a public or private corporation that's interested in the venture as part of its R&D portfolio, venture capital funds, business angel investors, a variety of nonprofit sources, and of course the entrepreneur and the entrepreneur's friends. Now, let me say something about how prospective investors are organized and what they do. The financing sources most relevant to our discussion are business angels and venture capital funds. Business angels are high net worth individuals who invest significant amounts of money and effort directly in new ventures. They tend to invest in relatively early stages and to invest relatively small amounts of capital, such maybe as a group, something like up to $500,000. They also generally employ less formal investment structures than do organized venture capital funds. Several of the participants here today are business angels or have experience as business angels and can discuss this further. Business angel investing is best suited for ventures where the enterprise needs a mix of capital and managerial talent, where the financial needs are long-term but not too large, and where a relatively small investment can advance the enterprise to a stage where larger amounts of funding will become available on more favorable terms. Most venture capital funds in the U.S. are organized as limited partnerships. Did I go the right direction? Yes. The limited partnership structure is a response to, well, actually, I'm going to stay on schedule too, and so I'm going to skip over a lengthy discussion of venture capital fund structure, but just tell you that they are organized as limited partnerships. The limited partners are the people who, or organizations who provide most of the financial capital. The general partner is an entity that usually is also organized as a partnership and provides most of the managerial involvement, including developing deal flow, selecting investments, structuring investments, monitoring the investments as they go forward, and harvesting. Both the financial investors and the general partner have to be compensated. And the normal structure of a venture capital fund is that the limited partners get paid back their investment, and normally a return of 20% of the capital 80% of the capital appreciation goes to the limited partners. The remaining 20% is usually a carried interest that goes to the general partner, and the general partner normally receives an annual management fee of around 2.5%. This is just a description of the structure of funds, but basically they're set up with finite lives. They normally last about 10 years, and the activities of the general partner change over the course of the life of the fund. Usually in the early stages, the focus is on deal flow and placing the investments. There's a period during the middle where most of the effort is involved in managing the investment, and then there's a period toward the end where most of the effort is related to harvesting. Now, I think the question that's important for this group is how high is the return, does the return have to be in order to attract for-profit investors into nonprofit organizations? And if you just listen to what people in the industry say, you get the impression that the returns have to be very high. Investors in venture capital often mention target rates of return that are 50 or 100%. Sometimes they talk about things like 10 times the increase, a 10-time increase in value over a 5-year period or something like that. But those are really target returns in the event that the venture is successful. They're not the expected returns. They don't take into account the probability that the venture might fail or not do as well as is hoped. Expected returns, expected in the statistical sense, that is, those sufficient to compensate limited partners adequately, are much lower. Financial economic theory suggests that investors would accept expected returns that are only modestly higher than the expected returns from investing in the stock of public companies. Historical evidence of realized returns on investments in venture capital funds seem to bear this out. Over the last 20 years, through annual rates of return to venture capital investing, while the annual returns have been extremely volatile, the average has been about 3.5% higher than the return to investing in the S&P 500. That difference of 350 basis points is more than enough to attract institutional investors. Most of them would salivate if somebody could promise an expected return that was 3.5% higher than what you could get in the stock market. And the thing I want to say here is just that these figures show the returns to the limited partners, not to the total fund. And in order to get the limited partners return up to around 18% or so, it would take something closer to 25% as a total return in order to compensate the general partner, cover the management fees, and that sort of thing. Now,
Richard, just in terms of how has that changed since the 1999 numbers on expectations?
You mean after the bubble?
Right.
It changed a little bit, but the numbers that I used in there, the long-term averages, have generally hovered between 20% and actually as low as about 14%. So this one I think is fairly representative. There are other ways of looking at it too. Like you can, if you use the capital asset pricing model to try to infer a required rate of return, you come up with essentially the market rate. The average beta in venture capital projects is, if you're familiar with the technical terms, is about 1. And if you go to a pension fund, there's really no reason for them to look for returns much higher than what they would get in the stock market. I have some notes about deal structure, and fortunately, I also have in your folder the text of what I was going to say, and I'm concerned about the time. I don't want to keep going on this. I think what I'll do is stop here, leave it to you to read over that if you need more information on deal structure and that sort of thing. And I'd like to just go ahead and move on to the first panel discussion.